Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, 22 minutes, we'll talk about a particular kind of mutual fund offering, which is the quant funds, and what is the importance of having quant funds in the portfolio, if you will. Of course, there is a new fund offering from the Aditya Birla house, Aditya Birla Sun Life AMC's house, which is a quant offering. So Harish Krishnan, who's the Co-CIO and Head of Equity at the AMC Johnson right now to talk about that and more. Harish, absolute pleasure to have you. The first time that we're talking on Profit. Thanks so much for taking the time out.
As always, a delight to be on your show, Neeraj, and looking forward.
Thank you, Harish. It'll be blasphemous not to check with you just the broad mood of the markets in your mind and what they will do over the course of the next 6 to 12 months before we talk about the NFO. How do you feel about the markets at these elevated levels, if you will?
Elevated levels is pretty much a right phrase at this point of time. I think, as always, as we keep saying, markets are an interplay of earnings, liquidity, and sentiment. Earnings are doing okay. They've of course doubled, more than doubled from the lows from COVID, and to a certain extent, I guess that explains the broader market construct as well, which have gone up more than 2.5 times from their lows. When I look at at say Sensex or Nifty, it is when we look lower down the curve in the broader markets, especially in terms of small caps and micro caps, that we do think that valuations have re-rated far in excess of what the earnings have gone through, and therefore a bit circumspect. We think that risk taking has got rewarded disproportionately over the course of the last 12, 18 months. Doesn't mean that we are negative on markets, but we think that it's going to be a lot more moderated, and a fewer set of pocket of stocks are likely to participate in the times to come through. And therefore, there is going to be some amount of consolidation between sectors and stocks, that are likely to continue to perform even as the markets continue to scale newer highs over the course of the next 12 to 18 months.
So narrower markets, Harish, is that what you seem to be indicating? Am I understanding it correct?
Yes, we do think that pockets will get narrower. There'll be fewer sectors that are likely to participate, is the broad sense that we have.
Got it. So in light of that, it's an interesting time to have an NFO, isn't it, Harish? So why such a timing, and why a quant offering at the current point of time?
I guess there never is a great time to do an NFO. I mean, it's only in hindsight that we'll know whether it was a great time or not.
Yeah.
But the reality is, I think more than the timing, it is about a differentiation in terms of what the strategy can itself bring through. More importantly, the diversification benefits of having such a strategy really come through. So, in essence, what is it really that we are telling is that there are certain strengths of human fund managers that also come with certain negatives, and there are strengths and weaknesses of machines. And therefore, it is our contention that man plus machine is greater than man or machine. So if I were to step back and look at from a first principles level, the real strength of the human fund manager, especially when it comes to Indian mutual funds, and this has been proven time and time again, is that Indian mutual fund managers generally do not like to partner with bad companies. And this is an extremely important diligence that human fund managers bring forth to the table, which has been proven over and over the course of the last 30 years or so. The negative, or some of the negatives of human fund managers, are that we do tend to get emotional, and even as much as we are all aware of the various behavioral aspects of how they can impact our decision making, at the end of the day, emotions do get the better of some of us, and generally when we think about emotions, between buying and selling, emotion plays a havoc in terms of decision making when it comes to selling. Because at the time of selling, there's generally a regret of either selling too early or selling too late. While at the time of buying, we can think of multiple frameworks that we can look at, be it valuation, be it a catalyst in the horizon, etc., that we can try to optimize that decision making better. Now, when we look at on the strengths of the machine, the strengths of the machine clearly is that they are unemotional. There are some very clear buy, more importantly, sell rules that come through, which reduces the human emotional aspect that plagues human fund managers. The negative of the machine is it is garbage in, garbage out, in the sense that they really don't have any element of discretion to determine which is a manipulated stock and which is otherwise a stock which is actually likely to create enduring and sustainable wealth creation. And therefore, there are these positives and negatives which, if we can join together, can try and help bring in some amount of repeatability in terms of investor experiences. And that is why, we think that this product can prove to be a useful addition in the overall portfolio of various investors.
Got it. So some of the other passive products, Harish, also talk about how the expense ratios are a bit softer, and therefore that's one more added advantage for somebody who's thinking long term. But I would love to understand from you, for some set of investors who are our viewers, maybe they're not completely exhausted their overall kitty of mutual fund investing, but some have, in the sense that they can always invest more, but they already have maybe 8, 9, 10 funds of different kinds in their portfolio. Let's assume they like what you're talking about and they want to add this fund to the portfolio, but they already have funds of different kinds meeting different needs. A small cap fund for exaggerated returns or elevated returns, a flexi cap fund for safety across the market caps, maybe a debt fund for adding that. So what kind of investors or what kind of replacement does a quant fund NFO give to a mutual fund holder? Who should look at a quant fund, and what kind of fund or option can it actually replace, if you will, if I'm getting through to you?
Sure. So the Aditya Birla Sun Life Quant Fund is essentially a fund which operates purely in the large and mid cap space. We will not have any small caps in terms of the exposure out there as far as this fund is concerned. So think about this fund as a pure large and mid cap offering with a bottom up benchmark agnostic kind of an investment framework. These are very important terminologies that I bring through. Large and mid cap, of course, everybody does understand what it stands for, but bottom up and benchmark agnostic. If you look at most funds which are managed through the traditional construct, and again we and I continue to manage funds in a traditional construct. It isn't so much that we are anti-active fund management, etc. But generally, most fund managers tend to have a benchmark awareness in terms of their strategies. It could be either in the form of, say, sectoral benchmarking. For example, if there's a large sector, for example, today it could be the banking sector where we may have, say, 30-35% weight in the benchmarks. Many fund managers typically tend to oscillate around that benchmark awareness as a strategy and move up and down compared to that benchmark. Now, while clearly that does bring in a reasonable amount of risk management and proven track record of active managers to create wealth for their unit holders, the quant offering at Aditya Birla Sun Life is primarily benchmark agnostic, in the sense that we are a pure bottom-up quant investing framework, wherein we are talking about, say, anywhere between 35 to 50 names at any point of time. As and when they get the quant signal, they are there in it. If there is no signal at any point, and I'm happy to take you through what I mean by the signal. If you or your audience requires, this will be present, and if it is not there, if the signal is not there, then there is no exposure of that particular stock. So in a sense, it's a very transparent, disciplined exit process. There are no half measures that typically come through in various other strategies. Either if a signal is there, the stock is there in full. If it is not there, it is not there. So therefore, it brings in sharpness, it brings in fluidity as far as portfolio construct is concerned. And more importantly, and this is, I think, the biggest reason why an investor who is already exposed to various funds need to consider is its active share. Active share is basically, how different a portfolio is from its benchmark. Most funds would have an active share of anywhere between 50 to 60, 65%. Here we are talking about active shares which are as high as 80, 90%.
Okay.
This is a very, very differentiated product. Like I said, this has no bearing as to what the benchmark stocks are or the benchmark sectors are. And
Clearly.
therefore, you get a very, very differentiated product, which is in the core of large and mid cap. The way our construct is that we actually take, the top 75 positions of each of the fund houses, that comes to a total of about 225 to 240 positions that go into the machine. So in a sense, it's a highly, very good quality names, which is there in most other actively managed portfolios. That is what goes into the machine. Therefore, the chance of garbage in, garbage out, which I referred to earlier, can be reduced quite dramatically, because this does go in from the oversight of various active managers who are all
Got it.
wanting to partner with good
Sure.
companies, and from there we're getting a fund which is very differentiated. So that's broadly why one should look at from within this construct.
Got it. Harish, I would have loved to talk about the signal, but I just have time, 60 seconds for one question. So I'll choose another question, if you will, and not the signal question. You've back tested this fund for past performance as well. What is the average return that you as a CIO believe this fund can throw up over a 5-year period?
So on the backtest from 2012 to 24, we've got any rolling 5-year period, we've got almost a 4 to 5% alpha over NSE 200 total returns. This is what the evidence is suggesting from 2012 to 24. I mean, the future is anyone's guess, but on a rolling basis, that's the 4 to 5% alpha that at different points of time, different market participants, if they had invested in the backtest, would have experienced post cost. This is the alpha that would have come through. We think that it's quite realistic to expect similar such, maybe slightly lesser, as with greater AUM, maybe there could be some reduction in the signal. But we do think that there's a reasonably good prospect of alpha generation that we can kind of evidence as far as these strategies are concerned.
Got it. And of course, simply put, past performance is not an indicator of what the fund will
That's
do.
right.
But Harish, of course, saying that it might be reasonable to expect this or maybe slightly lower 5-year performance on something like this as well. But yeah, quant investing is a very exciting area, and we have a new fund offer out there too. So Harish, thanks for joining in and explaining to us in whatever little time that we had about what this NFO is like. We wish you all the best for this, and thanks for sharing some of the details with us.
Thank you. Always a pleasure. Good.